Benchmark interest rate unchanged at 12% today. For more reaction on the committee's decision and the latest news driving Nigeria's fixed income market, we're now joined by Emmanuel Odiaka. He's a bond dealer at Diamond Bank. Emmanuel, it's always good to have you on the show. And maybe for me, the best place to start for you, the key takeaways from that MPC decision today.
Okay, thank you, Wally, for having me on the show today. Market has been hovering around with dissenting voice on the outcome of this MPC. I would rightly say it's one of the most anticipated MPC outcome for market in the last couple of months, owing to the fact that there's been dissenting voice and analyst views on the likely outcome of this MPC. We have seen the monetary authorities retain its benchmark rate, retain CRR, and market would take a lean from this. Market has been of the view slightly that there could be monetary easing, and that is why we have seen some slight volatility in the market, owing to the fear that monetary easing could herald hot money evaporation in the system, which could cause some major other panic, especially in the FX market. But MP, seeing their wisdom today, has maintained MPR and other monetary aggregates. We believe that going forward, market will take a leap on this, especially looking at offshore interests, their views on monetary tightening. I think this will come as a big relief to them, because the Nigerian fixed income market is still a market that is still they are still very much interested in. Going forward, we feel that we'll gradually begin to see ease in yield, going from the last 2 or 3 weeks events that has been very volatile.
Okay, how do you see it impacting the markets? I think you've already alluded to it a little bit. We've seen some volatility this week. Going forward, what do you think is likely to happen now that we've seen that key rate unchanged?
Okay, already with events of yesterday and today, from the trends that we have seen in the market, before now, like I said earlier, our market was of the view that there could be monetary easing, but as the day drew closer to today, there was a contractionary view to market view that of monetary easing and to maintaining the rates, and we saw yields easing slightly in the market today. I think going forward, we'll continue to see a slight reversal of the volatility we've seen to offshore interests coming back to the market and the domestic sector gradually taking position.
All right, while the MPC was going on, I think a key announcement today is the bond auction calendar for the second quarter. I want you to run us through that and the key takeaways for you, because I think for me, one thing that pops out very clearly is the fact that they're introducing some bonds with maturities of close to about 2 years. That seems to be unusual.
Okay, well, you're not out of place to have noted that. As a matter of fact, the Debt Management Office, DMO, will be reopening the 4% April 2015 maturity. In issue of this bond is over 500, about 500 billion of this bond is in issue already, and it was last issued in about this time 2010, because it was a 5-year paper then. And then tenure to maturity of this bond today is about 1 year, 11 months. That will come as a surprise to market, but I believe because the DMO is trying to deepen the market much, especially for players that want to be at the short end of the curve, and that would have informed them reopening this bond. Also of note in the Q2 calendar is the 20-year bond, the 10% July 2030 maturity, which will be reopened concurrently April, May, June. I think market watchers will put an eye on this very issue, because because of the nature of the long tenor instrument, it could have a way of tilting market in its way, depending on where yields will be coming out by April auction.
Right.